Yeah, hi. Hi, everyone. This is Nitin from Zerodha. Over the last 20 years of being a trader, sub-broker, and now running a brokerage firm, uh, I don't think there's been any other business that I've looked upon with more respect than Motilal Oswal because of the idea of promoting the idea of value investing. And today I'm even more excited to have the man behind the success of Motilal Oswal, Mr. Raamdeo Agrawal, take a webinar for all of you on best practices of value investing. So the plan is, we will do a 30-minute, approximately 30-minute kind of a webinar, and followed it by a 15 minutes of Q&A. Thanks a lot, sir, for taking time, and I'll let you take over now.
Okay. So I think today we are scheduled to talk about 0 to 1,000 crores. That's the format.
1,000 crore plus value investing.
Plus value investing. Okay. So I mean, because there are no slides, so
Yeah,
I will
sure.
extempore.
Sure, sir.
So good afternoon, viewers, and all the clients and prospective clients of Zerodha. I'm delighted to be with you all, and this investing has been my passion right from beginning from 1980. I couldn't have done anything else. By doing chartered accountancy also, I was stock market stock bluff and buff, and I used to collect balance sheets in the weekend and read through the week, and that's how I built my understanding of the stock market over the years. And sometime you are destined to what do you call get into something, and then everything falls in place. So I once I was traveling by train, and I saw an advertisement about the equity research, and I did apply for that in '85, and probably I was the only guy who applied for it. So I got the job and worked for 2 years, wrote a book, and finally we took plunge into the stock market in '87 with zero capital and just the leap of faith and confidence that we understand the market, we understand investing, and how so primitive it was, because that time things were not flowing. We were also young, and things were pretty primitive, and yet the confidence of the young guy, is so immense. We started in '87, and myself and Moti was younger than is younger than me, and he's a far better chartered accountant than me. He's almost a ranker. I attempts to pass my CA, and but one good thing was he had two brothers operating from Chennai and Ahmedabad who wanted to find a good broker in Mumbai. I was one guy who was knowing everything in the stock market, but I had no way how to get the first client and how to start the business. And that too, we didn't have any capital, any office, nothing. I found in him a great guy, and great guy with two clients, and wanting to work also hand to hand. So we came together, and we started the business. Day one, we had these two clients from operating from Ahmedabad and Chennai, and they used to buy stuff in those markets on a T+1 basis, and they used to sell it here on T+15 basis. So basically, we didn't need any capital because they were selling. So we needed, in fact, we were sending money to them rather than we needing money here. And that model of not needing any capital to start a business was the most wonderful thing when I look back. And second thing was that uh, the broker services were completely in short supply. We were in sellers market, and that allowed us to really build. People tolerated us because we were amongst the best, because we were giving research. We were beyond, above table in terms of integrity, and we were available 24/7 for small things also. So that allowed us to build our this thing. But our passion was investing. What we were doing, since the cash flow was small, and after expenses and everything, and after paying full taxes, we were left with a few lakhs. I was continuously investing. The very day I used to earn the brokerage, I used to invest, and that allowed us to build more than what booking could have done. And by 1990, we had about 15 lakhs saved into various stocks and everything. And then we bought a little bit and bought the membership. And that was a turning point. The moment we bought the membership, what happened was that there was a Harsha Mehta program. In next 2 years, in less than 2 years, we went from 15 lakhs to 30 crores. I had a 30 crores worth of stock portfolio at the peak of the bull run, and that changed the life. And that happens once in a lifetime, from literally 0 to 30 crores overnight. And we didn't speculate. It was not one stock bonanza or anything like that. We worked very hard those say, but kind of we reinvested very quickly and built this 30 crores portfolio. And then it had to collapse. It collapsed, and we became from 30 to 10. But 10 crore was also at that point of time a lot of money for any young entrepreneur. And then we started building. We started getting the research, writing research, and then somewhere in '94, I heard the name of Warren Buffett. I mean, I never heard him. I didn't know about them. Probably I had not heard Goldman Sachs also. So somebody gave me a physical copy of Berkshire Hathaway, and he said, "This guy is different. Why don't you read the director's report?" I read that, and then I realized, probably I don't know anything about investing, and this guy obviously knows everything. And, then I read 30 years of his all the annual reports, and that changed. That actually shaped my thought process about the investing, which brought some cohesion, some orderliness in. One thing about investing is that there is no structured way. There's no one way of doing it right. There are millions of guys. There are millions of ways of doing it right. The end thing is that everybody wants to make money, and the same market, same stocks. I mean, one guy buys, one guy sells. It means that there are two different thought processes working simultaneously on the same counter at the same point of time. So clearly, Buffett gave me the foundation for how to think about value investing, and it was love at first sight. On a 10 crore portfolio, I had about 225 companies. And the very first thing what I did was that I sold bulk of them and I left with only 15 companies. That allowed me to at least review my portfolio with 250 companies, 225 companies with 4 or 5 pages of your Excel sheet. It was impossible to go through even those companies in one shot. In that very year in which I did this, my stock portfolio doubled in value. And since then, we have never looked back. We have always had only focused strategy. In fact, our all the strategies are focused strategies. Even SEBI gave us the permission to launch focused strategies. So focus 25, focus 30, focus 35. I said, let me have voluntary binding on how many companies we can have. So focus 25 by our filing cannot have more than 25 companies at the construct itself, or 30 cannot have more than 30, and 35 cannot have more than 35. Actually, we operate with only 20 companies. Like we have capacity in terms of how many companies we want to have in our schemes. And PMSs they run more like 15, 17 companies. In mid cap is run with 20, 22 companies. But basically, 20 is the number around which we have a number of stocks in our portfolios. So that character from 96 onwards was permanent feature. And in 2003, when we started taking money first time, since then, I mean, we used to, I think still the value strategy, which is my oldest, has about 12 or 13 stocks even today. And that time also, I used to personally run about 15, 16 stocks. So this is the one of the biggest thing that you got to have focused strategy, focused number of companies, few number of companies in your portfolio. And then my this 10 crore portfolio, by turn of the century, became a 100 crore portfolio because this Y2K happened. Again, the next bull run, like mad bull run, which happened in 92, we again saw another bull run in 2000. That took my portfolio from 10 crores at the bottom to 100 crores. Again, it collapsed because my 80% of my portfolio was Infosys and Mastek, and both of them they collapsed by 90%, and hence my portfolio again came down to again one third from 100 to 30. Then we had 2 tough years, and then we started. Then the mother of all the bull runs started 2003, 2007, and during that period, what happened was that the dot-com bust had happened, and again the franchise companies like perfect recommended quality companies that started coming into being, and those are the companies which started doing well. And again we built the portfolios which were relevant at that point of time. And by the time it was 2007 at peak, we were upwards of 500 crores from the 30 crores. I'm talking about this is my personal portfolio. Between me and Moti, what personal portfolio savings we had. And but what happened was in '96 we became corporate, and after that I didn't get money from the operating side. Till then, operating and portfolio was one and the same. But after 96, once the corporate happened, the operating mind remained in corporate, and I started. I had to manage only out of whatever was the earlier purpose. So I didn't get much of inflow. At same 10 became 100, 100 became 30, 30 became 500. Then again the thing collapsed, but this time it collapsed by 50%. The bottom in 2008, when the market collapsed, we were at about 225 to 250 crores. And then now the same 250 crores has become more like 1400 crores as we are, as we are talking. So this is the journey of a portfolio which started with zero to 1000 crores in last say 25, 30 years. And if by chance, I mean, from 96 onwards, we started focusing only on the building Motilal Oswal financial services itself. So in parallel, while this progress, this was just a byproduct of the entire effort, we created a company which is about today, I mean, as we talk, it's about 2 billion, upwards of 2 billion, 15, 16,000 crores company. So the journey of, actually our journey is not from zero to 1000, it is zero to maybe 15, 16,000 crores. And still the journey is on, it's very robust, and we are as excited. And I think one or two things I remember about value investing. One is that I think one has to be looking for, I mean, one must recognize the difference between price and value. Price is what you pay, value is what you get. This is the fundamental of, I mean, if people don't understand, if people think the price and value are same, I think it's done. I mean, I don't think you should bother about the stock market. There is a fundamentally, this is the only market where you get, where you get 10 bucks thing and you can get it for 1 buck, and you can sell 1 buck thing for 10 bucks. You have to know what is the underlying value and what is the price there. So you have to have faith in this particular statement. And if you think that it's a very efficient market and the only way to go is the passive investing, and you cannot figure out the difference between price and value in any stock in any point of time, I don't think you belong to the game. So the guys who belong to the game are the guys who can see the difference between price and value. And what are the sources of value? So there are three sources of value. So what we did along the, can you just get me a bottle of water? So along the way, what we did was from 96 onwards, after the corporatization, after 96, we started writing wealth creation study. The effort was to learn, as Phil Fisher says, before entering any market, please try to understand how money is made in that market. Every country has different set of businesses and different set of companies who make money. We don't have Microsoft, we don't have Alphabet, we don't have Google, we don't have all this Facebook and things like that. Maybe we'll have them after 10, 15, 20 years. But today, what is making money here is TCS. TCS, you have your HDFC Bank, you have Reliance. I mean, very different kind of companies are making money. You have two-wheeler companies like Eicher, Hero Honda. I mean, these companies are making a lot of money. You have a car company, which is almost one of the most valuable car company in the world, Maruti Suzuki. So, these companies have a very different opportunities because of the level of development, the competitive structure which we have, the affordability, lack of affordability we have. All these things create a very different business opportunity, and entrepreneurs, they find ways of building an enterprise which is so very different in the same business in other parts of the world. Like say Asian Paints, having 60% market share in a paints business, which is very simple, yet the brand and the distribution has created so much of differentiation between him and the other players that next three players put together are 1/3 of his market share. So the kind of price dominance, pricing power, profitability, cost structure which Asian Paint gets, nobody else gets. So clearly, we have to figure out where the money is made. So to keep up with the thing, what we did from 96 onwards, we started writing wealth creation study, and we have done 21 parts of this study without fail. Every year, 2 months I spend in doing that, and now it has become far more useful to me because what we try to do are two things. One, of course, we look at the data for what has happened in the last 5 years, and that's the original wealth creation study. The second thing what we do is that we try to look at one of the aspect of investing which is difficult for us to understand, so that we try to sort it out in next 2 months, and we try to pen it down on the paper in terms of how do we look at it, like how to look at growth, how to look at value, how to look at the dividend, how to look at whole lot of things. So there are 21 studies we have done, and so the difference between, there are a lot of people who read the books. I mean, probably multiple times more than what we read. I read about a book or maybe one and a half book in a month. So I must be completing maybe 15, 17, 20 books in a year. There are guys who complete almost a book or more than a book every week. They will not get a sleep unless they complete the book. So, but then the difference between them and us is that they don't try to internalize. They don't run data on what are the insights they had from the book. What I'm trying to do, I'm trying to read fewer books more deeply, get few insights, and run the data and make it more internalized in the head. So when you go to pick a stock or manage a portfolio, at that point of time, those insights or the frameworks are of use for finding values. Basically, your price is known to everybody. You are continuously trying to improve your pace and size of value you can find, and when you actually improve your vision so that you can see the value or value being created, and price being where it is, you can sit through. So actually investing is nothing but stacking up the frameworks. You have to of the various variables you have to think about in value. So you have to have various frameworks, and the guys who have multiple frameworks of how to look at it, a lot of things come out of common sense and experience. So the stacking of the frameworks allows you to be a better stock picker. So we have done through 21 of them, and I'm quite sure we'll do another 21 is in line in as many years, and it will become deeper and deeper. And that also shows our own evolution of how we understand the value in the over a period of time. But one framework which comes to my mind, which is very powerful, is a framework given by Professor Greenwald in his book called Value Investing. And I think it came sometime in 98, 99. And there he has given a very clear, I wish I could give you a few slides, but so the value there are three sources of value. And first is the breakup value, second is the franchise value, and third is the growth value. So what happens is that till about 50s or 60s, after the depression and lack of limited computing power, people were looking at basically the breakup value. Can I get a company of which breakup value is $100 million, and today it might be trading at 20, 30, $40 million? That was the game, and people are buying dirt cheap stocks in those kind of prices. The quality of the higher profitability or quality of businesses were not given that much importance to start with till about 1960. Then Buffett came along with Charlie Munger, and Charlie Munger had a different take on this, and he said, let's buy high quality companies, and of course buy cheap, but buy high quality companies rather than just a breakup value. Buffett was coming from a Benjamin Graham's breakup value concept. He came and said, let's look at the franchises, and that's where Seas Candy, American Express, Coca-Cola, those kind of stocks they started buying, and put together it became a lethal combination of investing. And Buffett also got reformed from Benjamin House to becoming like a Manjar kind of thing. And then good thing they did to our benefit, they started writing in their annual reports what they learned and what their thought process about the quality companies. That made a lot of authors write a lot of books in 90s particularly, and now I think every week one book is coming on the quality investing. In fact, there is a book on quality investing itself which I am reading right now. So by Cunningham. So what has happened is, by buying only quality, you cannot find value, because what has happened is the quality is now fully valued, fully priced, I would say. So by very high quality companies also priced very highly, and the low quality companies priced lowly. So by buying high quality companies, you you cannot beat the market. You may not sink, but you cannot beat the market. Now, the second way to make money is to chase the growth. So growth has a problem because the bad companies also grow for a short while. So how do you differentiate between growth of a good company and growth of a bad company? Because every company is here to grow only. So and you get caught if you don't differentiate. So we call it quality trap if you're buying only quality. We call it growth trap if you're buying only growth companies without looking at the quality. So what we said finally in 2000, I think this we did in 2011 or 12 when we study. We said we are looking at the intersection of quality and growth. So high quality and high growth. When you arrive at that kind of situation, the even market finds it very difficult. If you're little early in the game, market finds it very difficult to value it rightly. Because then if you are high quality and high growth and longevity and high growth, so Q quality means high quality business run by high quality management. So Q is taken care of, G is taken care of. Then L is not only quality and growth, but longevity and quality and growth. For 10 years, 20 years, 30 years, it is good and growing. So when you have Q, G, L, that gives you a bucket of value. And the value in that is a compounded value in the sense that today value is X. In 10 years, if it is growing at 25%, the value becomes 10x. Now, now the price will be broadly reflecting current value. Current value of 1x, maybe because it is high quality, high growth, maybe it might be 2x, but it doesn't take full cognizance of next 10 years of value creation to the quality and growth. And that's where you get the opportunity or margin of safety of investing in quality and growth at reasonable price. So, all in all, value is about breakup value and current profit value, which everybody knows what should be the value. It's you put in the spreadsheet without putting any growth. You can put your discounting number and you'll get the present value of that. So that's a science. What comes to really problem is the growth value. In India, most of the companies, 50% of the current value of price is for the growth. Now, how to understand growth and how much growth is possible and what is the quality? At the same time, I mean, there can be growth in low quality company, there can be growth in very high quality company. When you get combination of very high growth in a high quality company, valuation is literally exponential, and no market can value it right. You'll always make money in those kind of companies. But there are very few opportunities where business quality is very high and very high growth is there, and you are buying at a early stage of the company. And that is possible in private equity, but generally these companies don't come to being in the marketplace. Like asset management companies, they will all come for investing in the days to come. First time we are getting listed, HDFC mutual fund, your ICICI mutual fund, will all come for listing. They are fantastic business with fantastic growth. Let's see what kind of valuation they attract to start with. That leaves an opportunity. So basically, as I explained, the value investing is about figuring out the franchise value and growth value. Franchise value is a science, growth value is an art. And understanding the growth, there is no school where it is taught which company, which business will grow how much for how long. You have to understand using your common sense and whatever data analytics you have, talking to the competition, talking to the company and everything. You have to figure out which company is going to grow how much. So it all depends on the quality of business, quality of opportunity, and execution capability of the management. So when all these things come together, you get a company which is going to grow like a fountain, like a rocket for many years to come. And that's where you get a compounder, and then you have to understand power of compounding. What happens is people understand in value investing, in investing per se, compounding has a huge role to play. I learned about compounding in '91 by late Mr. Chandrakant Sampath. He kind of talked about compounding, and it just stuck to my head. How powerful is the concept? So another concept is the power of compounding. If you have compounded, if you understand how compounding works, like at 25%, rupee becomes 10 rupees in 10 years. But what is the summation of 1 to 10 years profit of the summation of compounded profits is about 42. So you have to know at a given situation how much a company is going to make if the company is assumed to be growing at particular pace for a particular number of years. So that number, you can do it, of course, with the calculator, but if you can do it mentally, you can continuously see whether a particular stock is high priced or underpriced or overpriced. So this keeps going on in my head, and that allows us to pick the stocks wherever we find a spot. So I think I have summarized how I naturally operate at a stock selection level, and then comes the allocation, and then because one of the beautiful thing about in stock investing is that your downside is only 1x, whereas your upside is unlimited x. Like if you bought any company for say 1,000 rupees or say 1,000 crores market cap, the downside can be only thousand rupees. But upside can go from that 1,000 to 10,000, a lakh or 2 lakhs or whatever. Look at what is happening to Amazon or anything. Infosys, ultimate growth company in India, came to public issue and flopped public issue at 50 crores in 93. Today it is from 50 crores to 2.5 lakh crores. They pay dividends of thousands of crores every year. So clearly, it's a very interesting, it's a very exponential instrument. One must be aware of how to use the power of these companies. And if you get a diamond or a 100 carat diamond in your hand at early stage, high quality business, growing rapidly at a reasonable price, I think you need vision, you need courage, and you need patience to hold that. And what is most important of the three is not the vision and courage. What is most important is the patience. And unless you have the patience, power of compounding will not work. And in summation, all of this is what we practice at Motilal Oswal Asset Management, and that's why you get to see what the performance is. So I think I'll close my remarks with this, and we'll get into questions.
Yeah. Thanks, sir. That was very insightful. Okay, so I've gotten like 500 different questions, so I'm gonna select uh, 7 or 8 out of them, right?
Sure.
So, uh, starting off with a fun question. Now, it looks like the newspapers are saying that you're in the billionaire club. If
Yes,
so
keep asking.
if
Keep
you're
asking.
already so the question is, how do you spend your money? Other than investing, where do you spend your money?
We just got it here. We've not thought about it. So we have got it means we have. I think money is a very interesting thing. In the sense that it puts you into very interesting spots. It takes you to the places where you would like to be. It allows you to do things which you can do, and it brings a lot of freedom in every aspect of life, not only financial, but where you want to live, where whether you want to work, how long you want to work, where you want to work. So it brings all sorts of freedom, and I'm I'm going to enjoy all of it. And of course, bulk of the money will go to the charity. And I'm not going to wait for a very long time for charitable activity to start. We have started. See, one is that on the paper you are rich. Second is mentally how rich you are. For this, you have to be injected with the richness. It takes almost a generation to become rich. We are first generation guys. I don't think in this generation I'm going to become rich mentally.
Right.
But then, when the challenge is how do you dispose it off? I'm excited to even create more money, more wealth, so that we can do bigger charities in life. So you get to see some significant charities in the years to come out of disposal of my stake in the company.
Thanks. That's very nice. So now you're talking about Infosys. Now the question here is, do we really have stocks of value to be purchased today? What do you think about the current set of large cap and mid cap valuation? Is there that value in the market today to go and put your money in?
Yes, in a QG kind of situation, you might be paying full price today, but on a 3 months, 6 months, or 1 year basis, maybe we can have a return holiday for 1 year. We
Right.
don't make any money for 1 year, but life is not about 1 year, no? Out of 10 years, 9 years still ahead. So once say, you might say that that market is kind of, let me think that what the world is saying is right. that market is little expensive by say 25%, and my earnings growth is 25%. So 1 year I will not make money. After 1 year also, my say 30p will come on 21, 22p, and then we start the journey. But my growth in the growth engine of my portfolio or my company is going to continue for next 10, 15 years. So how does it matter? I'll make as much money in the years to come.
Right. Got it.
You
But
have to have
then,
that. You're not going to make money every day.
right. So does it make sense to then sit more on cash now if value is not there, or how do you decide on that? I mean,
One thing is there are two types of guys. The guys who are already invested, like people like me, and hopefully people like you who have this. And I have 100% only in stocks. So to me, it doesn't matter getting another 1% or 2% by way of dividend or something. That is in any case still that. That has to go into stock the very moment it comes. Like 9 o'clock, I get credit. 9:30 it goes in the market. So for me, it's a very easy decision. For the guy who is starting first, he said that he has never ever dabbled into the stock market. For him, it is a tough entry into the market. It's like a entering into a swimming pool without any, like with all the bubbles around you. So you are all, the guy who's most protected. He is most scared when he enters the pool. The guy who doesn't have on his back, he's absolutely, it's like me. He's a very free bird. So the guys who are entering for the first time, since they are fearful, you must respect their fear, and you can go in installments. There's such wonderful thanks to technology, wonderful ideas available like systematic investment plan. You can do a weekly plan, you can do a monthly plan, you can do a quarterly plan. You decide. See, you have paid money. Now you don't have to sweat about how to use the money. So you deploy at your pace when you are comfortable. You buy it in the next 1 year, 12 installments or 3 installments, 4 installments. You get average of the market. If the market goes down, you get rest of the money you buy or something like that. So I think there are ways around this, but you cannot learn swimming staying out sitting out there. You have to enter the.
got it. Now, I think there's an interesting extension to this. So a lot of people would want to emulate you, right? As in, go to 0 to 15,000 crores, right? I mean, so the question here is, so you made money investing into stocks directly. Can the same kind of returns be made through a mutual fund? Like investing into the SIP. I mean, can something like that be emulated? So
Much better, much better. Because when I started, mutual fund was not there, or so I was trained in a single stock kind of a scenario. And even now, I mean, now you have both options. You can go stock straight into stocks, or you can do it through mutual funds. Very few guys are competent to do what we did at that point of time because market is much more competitive, hyper competitive right now. You need far more focus. You need a lot more rating because that time competition was retail to retail. The whole market was dominated by speculators and dealers and the investors, which were retail and literally illiterate retail kind of situation. Today, retail itself has become very smart. On top of it, 40% of the market is institutionalized. You got 20% mutual funds in India and 20% FIs who are very smart. So your competition is not, it is very different. Information is flowing far ahead of time. There's a quarterly result. There is a direct boardroom interviews. There is a severe requirement that anybody is meeting anything and any presentation is being made to any worthwhile investor has to be preloaded, not even postloaded. So what I'm saying is this is a very competitive situation. Internet is making life far more competitive for the investors. But those few who are competent, who has passion and who have time, obviously they can buy individual stocks. But I can tell you there are wonderful managers, wonderful products which are being done at 1.5% fees. People are devoting their whole lifetime experience to see that those products are doing well. Just be part of it. And the day on which you feel that you are more competent than the professional, you're free to kind of manage it on your own. It doesn't take much time. Second thing is that most of the guys who have portfolios, they don't realize because what they don't do is they don't do monitoring of their portfolio. The moment they give money to a professional, they get monthly statement, they get daily NMEs and things like that, and they can monitor it. But the way they manage their own portfolio, they never compare their own performance properly on year-on-year basis, quarter-on-quarter basis, with the benchmark and with the peer set. So I think there's a lot of merit in going to mutual funds for the people who have limited money, who have limited time, limited skill, and limited liking for doing it. You cannot do it unless you are a mad fellow. I mean, I would call anybody who's spending 24 by 7 in stock market nothing less than mad guys.
Okay. No, we like our clientele, we have a lot of such mad people. Now, if you have to select, like if you have to choose between low PE, low, I mean, how do you actually select a company? Do you give more focus on the financial ratios or more on the management? I mean, what is more priority for you?
So it's a bottoms-up process. I mean, the QGLP allows me to go through the entire thing. It's a checklist kind of thing. So you have to look at the quality of business done by quality of management. These two things, quality of business and quality of management, are 90% of the job. And if you are experienced, you can do both of them like very quickly. And of course, the final judgment is a little later. But whether it's a good business or bad business, that you have to fundamentally decide. And 90% of business are bad businesses. And time is friend of good business, and time is equally big enemy of bad business. So one of the difference between stocks and gold is that gold, anywhere you go, is same gold. You don't get cheated about the gold. Whereas in a
Right.
stock, you can be completely cheated because there's one side you have Nestle and Lever and Infosys and Wipro and TCS. Other side, you have all the jokers, who are just destroying their own money as well as investors' money. And unfortunately, they are much more in news, the bad guys, and there out of 4,000, I would say almost 3,500 companies are not worth investing for long term. How do you
Right.
build a portfolio of investable companies? That's the first part. So one is the terrific business, then the terrific set of management. Now, how do you interview a management? How do you see the passion of the management? And management, when you're looking at his competence, you're looking at his integrity, you're looking at his passion, energy. So these things, to some extent, is a matter of experience. But if you confront any management, you see the activities, you read the balance sheet, read the con call, I think you can see that difference between a management and management. So
Go.
once you have a terrific business run by terrific management, you are in for a ride to moon. Okay. Now, whether the ride is going to be at the rate of 25% compounded, 50% compounded, 20% compounded, it all depends on the growth. Once you have a good shape, you need the G. Because you can make as much money only as much as the company makes. If the 20-year growth rate is at 25%, you're bound to make at least 25%. Maybe half percent here and there because for rating or derating. So what is important is to get the Q and G right, and then you can look at the price.
Makes sense. So last two questions, So now,
Yes.
so a lot of is talked about, entering a stock, right? But I
Yeah.
think a lot of questions we had was how do you figure out when do you get out of a stock, right? As in, because that seems to be a lot more tougher decision to make than entering a stock, So
Yeah. So cornerstone of investing is buying right. If you buy right, say you get lucky to buy, say, Hero Honda at 30 bucks, or Bharti Telecom at 25 bucks, or Infosys. I mean, I know a few guys who bought Infosys on day one of listing at 50 crores market cap. Can you believe this? And they're still up. So you become lucky to find these ideas well in time and your prepared mind. Then selling is important, but you don't have to sweat about it. I mean, I sell when I'm wrong. First thing, I don't wait for the market to correct my wrong. I just get out and I die only once. So that's one thing. Second is when the companies are wrong. Capital allocation, they do go and buy something in Africa, something somewhere where they don't know what they are buying or selling. I stay away from there. We have to sell again. Third is when you get a superb opportunity, then says that no company is going to be growing perpetually, otherwise they'll go to the sky. So when the growth momentum slows down and you see other companies which are coming up with a new growth momentum, obviously you have to switch. These are a few situations where we keep doing it. And that's why out of 15, 20 stocks, 2, 3 stocks every year changing.
got it. Thanks. And the last one. So so I mean, you're like a role model for a lot of us here, right? So what would be your advice, for everyone who's starting off investing in the markets or who's been at it for a while? And I mean, if you have like a couple of pointers for all of us, so.
See, one of the advice given in 2000, one thing is, if you can read, you please read 2007 annual report of Berkshire, 6 and 7. And they talked about what they want to buy and what they want to avoid. Great. The title is Great, Good, Gruesome. I think it is the best 2 pages ever written by Mr. Buffett. That's my all-time favorite. 2007 Berkshire Hathaway, page 6 and 7. Okay, so that's the first thing you must read. And read not once, read at least 40 times. Even I read day before, again I got some insight, very insightful page. So, the first point there, he said 4 things they like to do. First thing is we invest what we understand. We don't do anything in investing which we don't understand. Let the world say you're a fool, you're whatever. But please don't write your check or do anything unless you are very clear about it. You're confident about that you are doing right thing. Again, look for top quality business with a long term good economics. Third, find a company which has trustworthy and able management. And fourth, and very fourth, is the price at which you are buying. It's a reasonable price. So when you follow this process, there's a process you follow. And if you follow the process of not doing crazy thing in investing, don't be carried away by momentum in the market and all. So, say like I said, if you're scared of the market levels and all, do an SIP, But I think you have to start investing. And in investing, if you are young, I think a lot of time is ahead of you. Right in front of me, when I started, I bought my first stock in 1980. Index was 100. Sensex was 100. Today it is 30,000. I have seen in front of me markets going 300 times. There is no reason that this market is again not going to go 300 times in Sensex terms in next 30 years. In fact, probably it could be faster. So I think the opportunity is fantastic. The downside is probably could be 10%. Upside is by 100% at least in next 5 years. With this, I would think that people should take very careful decision of whether they should do it themselves or they buy some product from guys whom they think they're competent. And you can even diversify within that. You don't have to put all the eggs in one basket. So that would be my advice.
Perfect. Thanks a lot, sir, for taking time. So and look forward to hearing more of you.
Sure. Thank you.
Thanks. Good day. Bye.